Hi everyone, this is Dr. Mark Dennis joining you once again. Welcome to our Week 4 live chat segment for Finance 4443, Financial Policy and Strategy. In this session, I will walk you through some helpful final project tips you can use to succeed on your capstone analysis of a fictitious company. Let's get started. In this segment, we are focused on your final project, which is built around Northwest Florida Chemicals Incorporated, again, a completely fictitious company. You'll be applying your understanding of financial forecasting using the two-pass method to determine whether the company needs additional funding. We'll start by understanding the additional funds needed, or AFN, using the two-pass method. This method will help us accurately forecast financial needs for the company. In this module, we'll review what pro forma financial statements are, why forecasting matters, and how to estimate break-even points and profit or loss thresholds. These are critical skills in strategic financial planning. Pro forma financial statements are forward-looking documents that estimate a company's future financial performance. One critical aspect of financial forecasting is determining the additional funds needed, or AFN, to support projected growth. The two-pass method is a systematic approach to calculate AFN, ensuring the accuracy of forecasts by refining initial estimates. The two-pass method is a systematic approach to forecasting. It starts with a rough estimate, known as the first pass, then revises it using updated assumptions in the second pass. This iterative method increases the accuracy of your financial projections. Here's how the first pass works. Step 1. Project the company's sales growth. Then estimate how spontaneous assets and liabilities will change with those sales. Next, forecast what new assets may be required. Then, determine changes to spontaneous liabilities and retained earnings. Finally, calculate your initial estimate of additional funds needed. Let's examine each of these steps in more detail. Projecting sales growth. Start by estimating the future sales based on historical data, market analysis, and growth assumptions. If current sales are $1 million and the growth rate is 10%, for instance, then next year's sales are projected to be $1.1 million. Pretty straightforward so far. Estimating spontaneous assets and liabilities. Some assets and liabilities will change automatically with sales. These are the spontaneous items. For example, if accounts receivable are usually 20% of sales, and projected sales are $1.1 million, then receivables would rise to $220,000. Forecasting additional required assets. It is important to identify any non-spontaneous or strategic assets the company might need to support growth. These will not change automatically with sales. Therefore, you will need to forecast them manually. Here we calculate the total assets required to support the new sales level. According to the formula, total required assets equals current total assets divided by current sales, and then we multiply that figure by projected sales. For example, if the company has $500,000 in assets and $1 million in sales, The required assets for $1.1 million in sales would be $550,000. Determining spontaneous liabilities and retained earnings. Here you must estimate the increase in spontaneous liabilities and retained earnings that will accompany the sales growth. To do this, factor in the increase in liabilities, such as accounts payable, and retained earnings based on the net income which the company keeps. Remember, retained earnings equals net income times 1 minus the payout ratio. You may want to pause the playback here for a moment and walk through each of the formulas shown here. Observing the formula, spontaneous liabilities equals current spontaneous liabilities divided by current sales, and that figure is then multiplied times projected sales. For example, if current spontaneous liabilities are $100,000, they would increase to $110,000 with the new sales level. Retained earnings depend on the profit margin and the payout ratio. If the net profit margin is 5% and the payout ratio is 40%, retained earnings from the projected sales would be calculated as follows. Retained earnings equals projected sales times net profit margin times 1 minus the payout ratio. Using the numerical examples here, that's 1.1 million times 5% times 1 minus 40%, which equals $33,000. Calculating initial additional funds needed. AFN equals the increase in total assets minus the increase in spontaneous liabilities minus the increase in retained earnings. Use the AFN formula to estimate the additional funds needed. According to the formula, AFN equals required increase in assets minus increase in spontaneous liabilities combined with increase in retained earnings. Follow along on the slide to see the numerical values that accompany these variables. Using this example, the additional funds needed are $7,000. Now we come to the second pass. This is where you review the numbers, adjust assumptions like sales growth or margins, and then recalculate to finalize the additional funds needed. Review and adjust the initial assumptions. Be sure to think critically here. Check the initial assumptions for accuracy and make adjustments as necessary. For instance, refine the sales growth rate, profit margins, and payout ratios based on any new data or strategic changes. Were your growth assumptions too aggressive? Did you underestimate costs? Make any necessary tweaks before moving forward. Recalculate using adjusted figures. Use the updated assumptions to recalculate the required assets, spontaneous liabilities, and retained earnings. Let's suppose the growth rate is revised from 10% to 8%. Projected sales would now be $1.08 million. This change affects all other forecasts, so be sure to update every dependent variable. Once you've refined your inputs, finalize your additional funds needed. This figure will guide your recommendation on financing needs, whether external funds are required, and if so, how much. Determine the final AFN by recalculating based on refined figures, ensuring the forecast aligns with realistic and achievable financial goals. Illustrated here are some tips of how you might apply the two-pass methodology to the case study presented for your final project. Notice how the change in interest expense is assumed and applied during the second pass for the future income statement. The same goes for the pro forma balance sheet. Use it to show how assets, liabilities, and equity will shift based on your forecasts. In this example, explore how the following deltas or changes ripple through the forecasted income statement on the second pass. Notes payable, long-term debt, and retained earnings. Remember to also examine key ratios. Liquidity, profitability, and leverage ratios provide insight into whether Northwest Florida Chemicals is financially healthy under your projections. Several key ratios are also affected by these forecasted changes. Profit margin and return on equity are only half that of the industry average. What is the significance of this? Be sure to spell this out as part of your project. Another question. Days Sales Outstanding, or DSO, is high. What might be done to improve this? Furthermore, how might an improvement in DSO affect the low inventory turnover ratio? If Northwest Florida Chemical has excess capacity in fixed assets, then you will not need to add more unless projected sales exceed that capacity. Always check for this before assuming new capital expenditures. Notice the additional fixed assets needed equals 0.1875 times predicted sales minus capacity sales. If predicted sales exceed capacity sales, otherwise, no new fixed assets will be needed. In this case, predicted sales equal 1.25 times $2,000, which gives us $2,500, and this is less than capacity sales. Therefore, the expected sales growth will not require any additional fixed assets. Break-even analysis. Operating break-even tells you the sales volume needed for Northwest Florida Chemical to earn zero operating profit. Use this to evaluate risk and viability. If we were to plot break-even on a graph, let's take a look at what that looks like. Let's dive into the break-even analysis for Northwest Florida Chemical. Here we see the relationship between total sales revenues, total operating costs, and fixed costs. The break-even point is where the total revenues equal the total costs. If Northwest Florida Chemical can produce and sell 20 million units of the chemical, should the proposal be adopted? This is the kind of strategic question your final report should address. The degree of operating leverage for this level of sales indicates that for every 1% change in sales, net operating income, or earnings before interest and taxes, will change by 4%. Therefore, if sales actually were 10% higher than expected, earnings before interest and taxes would be 40% higher than expected. To show that this is correct, consider what the operating section of the income statement would look like if Northwest Florida Chemical sales actually were $200 million times 1.10, or 220 million. You may want to pause the playback for a moment and examine these calculations carefully. If sales turn out to be 10% greater than expected, earnings per share will be 10% times 20, or 200% greater than expected. Break-even analysis can be used to help determine the feasibility of the proposal. As the above analyses have shown, Northwest Florida Chemical would have to sell at least 15 million units of the chemical before the proposal will begin producing a profit. Northwest Florida Chemical expects to be able to sell 20 million units, so it appears the proposal will indeed be profitable. Financial and total leverage. Leverage analysis can help determine what the impact on earnings per share will be if Northwest Florida Chemical does not meet its sales expectations. For example, the degree of total leverage, or DTL, for this proposal at 20 million units is 20x. Therefore, if Northwest Florida Chemical adopts the proposal and sells just 5% less than expected, net income will be 100%, 5% times 20, less than expected. To see this, the income statement for sales units equal to 19 million equals 20 million times 0.95, as shown here. The degree of total leverage suggests the proposal is fairly risky if the expected sales level of 20 million units. If the expected level of sales were much higher, the proposal would not seem quite so risky. This concludes the final project tips segment for this week's live chat series. See you online.